fast are you growing?
Very.
Net losses, they were in the billions of dollars.
What kind of numbers are we talking about?
We're talking about probably one of the fastest physical expansions that has been seen for the past 10 years.
WeWork has reported a first quarter net loss of $2.06 billion.
Are you actually turning a profit in
We
the
are
business?
definitely turning a profit. I'm bored of the businesses that don't turn a profit. I don't believe in them. I need a cash flow positive business.
The company was one of the hottest startups in history. Then it plunged from nearly $50 billion in value to basically worthless in just 6 weeks.
That is WeWork.
In 2019, Adam Neumann blew up a $47 billion company. He walked away with $1.7 billion. His employees walked away with nothing. 3 years later, Andreessen Horowitz, the most famous venture capital firm in the world, handed him $350 million to do it again. Not as a loan, not as a last chance, as the largest seed check Andreessen Horowitz has ever written. And by April 2025, they had written him another one, a $100 million follow-on that pushed Flow's valuation to $2.5 billion. That's over $450 million from a single firm to the same founder who presided over the second largest venture capital loss in history. Neumann's net worth today, according to Forbes, sits at approximately $2.2 billion. The man who destroyed a company is wealthier than when he started it. And for the last 4 years, almost nobody has asked the obvious question: why? In 2010, Adam Neumann and Miguel McKelvey opened the first WeWork in Soho, New York. The pitch was simple. We're not a real estate company. We're a tech company. That single sentence was worth $40 billion in valuation lies. The distinction mattered because technology companies trade at revenue multiples. Real estate companies trade at asset multiples. By calling itself a tech company, WeWork unlocked a valuation framework it had no business occupying. Once the tech narrative takes hold, WeWork scales aggressively across global cities, signing long-term leases while collecting short-term membership revenue. Growth becomes dependent on continuous fundraising rather than profit. Each funding round increasingly covers existing lease exposure, embedding structural financial risk beneath the company's rapid expansion story. 2017, Masayoshi Son, CEO of SoftBank, meets Adam Neumann for 12 minutes. He writes a $4.4 billion check. The valuation soars to $20 billion. By the time of the S1, WeWork had raised a total of $12, $8 billion across its life, more funding than almost any private startup in history. By 2019, the valuation hits $47 billion. The company has never turned a profit. That scale of capital didn't correct the model, it intensified it. With SoftBank's backing, WeWork doubled down on expansion, taking on more leases across global markets while losses widened beneath the surface. Internally, growth targets accelerated faster than occupancy rates, creating an imbalance that no new funding round could stabilize. August 14th, 2019, WeWork files its S1 with the SEC to go public. The filing reveals $900 million in annual losses. It reveals Neumann sold $700 million of his own stock before the IPO. It reveals he leased buildings he personally owned back to WeWork. It reveals he sold the trademark for the word "we" to his own company for $5.9 million. Within weeks, investor roadshows stall as major institutional backers question governance and profitability assumptions. The IPO process slows internally, forcing emergency reassessments of valuation. SoftBank begins pressing for structural control changes, while internal confidence fractures as WeWork shifts from a growth story to a financial liability under public examination. The valuation collapses. $47 billion, $20 billion, $10 billion, 30 days. September 30th, 2019, the IPO is withdrawn. Adam Neumann is forced out. The company he built would eventually file for Chapter 11 bankruptcy in November 2023, disclosing $18.65 billion in total debt against $15 billion in assets, a structural collapse that had been written into the business model from the start, but not before securing the biggest golden parachute in startup history. Within weeks, the IPO is completely pulled after investor demand collapses and valuation cuts fail to stabilize confidence. SoftBank steps in to restructure control as lenders and landlords begin reassessing exposure. Internally, WeWork shifts from expansion mode to survival, marking the end of its private market momentum and rapid growth narrative. When Adam Neumann walked out of WeWork, he didn't walk out broke. He walked out with more money than the entire company's remaining cash on hand. The exit package: $185 million consulting fee, $500 million in loan forgiveness, $1 billion stock buyout from SoftBank, total $1.7 billion. That figure was later renegotiated. The Wall Street Journal reported in 2021 that Neumann received $106 million in additional cash, $432 million in refinanced debt on favorable terms, and $578 million in WeWork stock sales through a controlled entity. The first number undersold it. While WeWork employees lost their jobs, their stock options, their severance packages, the company struggled to pay severance to roughly 2,000 laid-off workers. Visa-dependent employees were deported after layoffs. SoftBank would eventually lose $14.3 billion on the investment, the second largest venture capital loss in history. Adam Neumann walked away with $1.7 billion. That's the money we're about to watch him spend. The fallout didn't stay contained within WeWork. It spread to SoftBank's broader portfolio. The Vision Fund posted multi-billion-dollar losses as overvalued bets were marked down across companies. WeWork became the most visible symbol of that exposure, forcing a global reassessment of aggressive late-stage tech valuations and unchecked growth investing. Inside SoftBank, the damage triggered internal restructuring and a shift away from unchecked megadeals. Investors questioned the Vision Fund strategy itself. WeWork remained central to the narrative, a cautionary example of valuation driven more by belief than fundamentals. Adam Neumann went shopping. Total documented residential real estate footprint, $90 million or more. A 2,000-acre ranch in Wyoming, a 6,000-acre ranch in Utah, Miami properties across multiple neighborhoods. But the acquisitions weren't just personal. Investigative reporting later revealed that between 2019 and 2022, Neumann quietly acquired stakes in more than 4,000 apartment units across Atlanta, Nashville, Miami, and Fort Lauderdale, all before flow was publicly announced. He was building the inventory before he named the company. Between the collapse and the comeback, something unusual happened. Neumann didn't exit the system. He stayed inside it. While headlines focused on lawsuits and SoftBank's losses, inside venture circles, his name didn't vanish. It got reclassified. Not as failed CEO, but as high-velocity founder. Because in Silicon Valley, capital doesn't always chase success. It often chases repeatability. Even destructive outcomes can be reframed as proof of scale capability. Neumann's wealth didn't sit idle. It was quietly repositioned into real estate holdings, structured through multiple entities, each one distancing ownership from visibility. Miami condos, ranch land, and development-adjacent assets formed a pattern, convert volatility into geography. But none of this looks like a comeback yet. It looks like preparation. In 2019, Neumann and his wife formalized that preparation by co-founding a family office called 166 Second Financial Services, a private vehicle to manage and deploy their personal wealth into real estate and venture startups. The infrastructure for the next company was being built before anyone was paying attention. May 2022. 3 months before announcing Flow, Adam Neumann and his wife Rebecca Co. founded Flowcarbon, technically his first venture after WeWork, a climate crypto token company. The pitch: use blockchain technology to tokenize carbon credits. The funding: $70 million. The lead investor: Andreessen Horowitz. This is the first time A16Z funded Adam Neumann after the WeWork collapse. 2019, Neumann destroys $47 billion in value. 2022, A16Z writes him a $70 million check. By 2023, investors were suing for refunds. Most of the media missed this entirely, and almost nobody connected the dots when, 3 months after Flowcarbon's funding was announced, A16Z wrote the $350 million flow check. That wasn't two separate decisions. That was a pattern already in motion. Between 2020 and 2022, Adam Neumann gave exactly the same interview 17 times. He called WeWork the greatest personal and professional education of his life. He said he'd grown. He said he was humbled. He said he was ready to build again. The script never changed. The venues did. Each interview was a controlled reset, same contrition, same language, same framing. Silicon Valley, built on the mythology of the founder who rises from the ashes, was exactly the audience designed to receive it. When a 16Z eventually wrote the $350 million check, some tech entrepreneurs publicly criticized the firm for rewarding a failed, ethically questionable founder with its largest single investment, while others struggled to secure funding. That reaction didn't slow anything down. The rehabilitation tour wasn't incidental to the comeback, it was the infrastructure for it. August 15, 2022. 36 weeks before WeWork filed for Chapter 11 bankruptcy, Andreessen Horowitz published a blog post titled Investing in Flow, written by Mark Andreessen. The post confirmed a $350 million seed investment in Adam Neumann's new residential real estate company. Critically, A16Zers didn't just write a check. They received a direct stake in Flow's real estate portfolio as part of the deal. This wasn't standard equity. This was structural alignment with the assets themselves. This was not standard. This was historic. The average A16Z seed check at the time, $5 to $15 million. Neumann got somewhere between 23 and 70 times that for a company with no product, no revenue, no meaningful operations. And that investment made Flow a unicorn valued at over $1 billion before it commenced a single operation. The $350 million wasn't just large, it was structurally disproportionate. Andreessen Horowitz wasn't betting like a traditional VC. They were leaning into a thesis that certain founders don't restart companies, they restart gravity. But that creates a contradiction. If failure doesn't remove you from the system, Mark Andreessen's blog post described Neumann as a visionary leader who revolutionized the second largest asset class in the world. Not attempted, not sought, revolutionized. The post described him as a repeat founder building on past successes, growing from lessons learned. What it didn't mention, SoftBank's $14.3 billion loss, the self-dealing, the trademark sale, the excess, the governance failures, all public record. The actual model: buy apartment complexes, install a branded tech layer, add services, charge residents. In February 2024, Neumann attempted to buy WeWork back for over $500 million. The bid was rejected. The company was sold for less. By April 2024, Flow launched its first South Florida properties. Both were already nearly full before the brand even went public. Analysts immediately called it WeWork for apartments. In October 2024, Neumann added a co-working product inside Flow buildings, the same product, in a different room. Flow isn't just a product, it's a structure. It compresses landlord, platform, and service provider into one system. That reduces visibility. And in this case, visibility is the entire issue. Here's where the $350 million went. A16Z funds Flow. Flow routes capital through LLCs into apartment complexes. Those properties are leased to residents under Flow branding. Revenue flows back into the system. The loop repeats. By 2025, Flow controls more than 3,000 apartments across multiple regions, built in under 3 years. The structure is not illegal, but it is opaque, and opacity is where risk lives. The $1.7 billion exit wasn't a reward for success. It was a contractual outcome of failure at scale. Investor agreements had been structured in Neumann's favor early on. His payout wasn't tied to performance. It was tied to deal design. Now public filings show Neumann-affiliated entities adjacent to Flow properties. The question is simple. Is he leasing assets to himself again? The pattern is documented. The answer is not. Why a 16Z did it? So why did Andreessen Horowitz give Adam Neumann $350 million? Because of founder mode. The belief that repeat founders, even failed ones, have an advantage. That scale matters more than outcome. By that logic, Neumann's failure isn't disqualifying, it's evidence. A16Z has now funded him 3 times across 3 years. That's not a bet, that's a commitment. Remember flow carbon? By 2024, investors were suing for refunds. A16Zs knew this. They funded flow anyway. That's not ignorance, that's a pattern. Each new investment reframes the last failure. Neumann's second act isn't unique, it's structural. Silicon Valley doesn't punish failure, it funds familiarity. The pattern repeats: failure, fallout, restart, different founders, same system. Section 15. What happens next? The unanswered questions. As of early 2026, flow is expanding. New properties, new markets, new capital. The questions remain. Is there self-dealing? What do the financials show? Who holds control? When does scrutiny begin? And who is supposed to stop it? WeWork employees who received severance, 0. SoftBank's loss, $14.3 billion. Neumann's exit, $1.7 billion. A16's investment, over $450 million. Flow's valuation, $2.5 billion. The gap between accountability and repetition has never been wider. Close. Adam Neumann's second act isn't an anomaly. It's a signal. Silicon Valley is not in the business of punishing bad actors. It's in the business of funding famous ones. And the question this series will keep asking: if destroying $47 billion buys you a $350 million second chance, and then a $100 million third, what does that tell you about the people writing the checks?